Hey everybody, welcome back to the Wolf Den, episode 6. I actually can't believe we're that far into this whole journey of mine, but love every minute of it. You might recognize this guy from episode number 2, Mark Angelone with Movement Mortgage, the best lender that I personally know. This guy has handled, 50, 60, 70 deals for me over the past 8.5 years. We broke into the business together. We've been ride or die ever since. I roll with him whenever I can. He's the first person I recommend. So just figured I'd bring Mark back to give a little bit of an update onto what to expect for the spring market. We're heading into the hottest time in real estate for myself and for guys like Mark. So just figured we'd get a little head start on what's going to happen. So welcome back, Mark.
Thank you. Thank you for having me. I love being here.
Yeah. Oh, well, listen, no better place than the Wolf Den.
Love it. I love it.
This is the real estate
The
mecca.
Wolf Den is growing, man. It's awesome.
Real estate mecca of Bucks County right here in New Hope.
It is.
Yeah, maybe just start out, just kind of go into, what you're looking forward to this spring, what your thoughts. I know it's hard to predict what rates are going to do, but what's your prediction on what rates are looking like now and going forward into the spring? How your business is looking, how it's scaling for the year, and just anything else you want to kind of jump on just to start things out.
Yeah, absolutely. So thank you again for having me, man. I really appreciate all the kind words.
Absolutely.
Love working with you as well. But it's a crazy time to have this podcast in general because rates are swinging like crazy. And it's not always just up or down. Obviously, with everything going on overseas and oil prices skyrocketing.
Just unpredictable stuff.
Rates have been, they were down into the 5.8 range, and then now they're back up into like the low 6s.
Yep.
But I haven't seen that having any impact on pre-approvals, like people have an urgency to buy. Right now, March and April are always, we're doing a lot of pre-approvals.
It's like the ramp up.
That's kind of the ramp up. Yeah. I mean, the year started off very strong. I think our volume has almost doubled at this point this year versus last year.
Awesome.
But it always goes in waves. But I think what we're seeing is people were on the sidelines for 2 years.
Yep.
Basically, the reason that first-time home buyer age is now in the 40s is because everyone just kept renting. So now all that demand is pent up.
I bought my first house at 41, 42. So I am
Right.
a great example of that. I wish I did it sooner, trust me. But
Yeah. And I mean, listen, better late than never, of course.
Yeah.
But like, that's not even late anymore. That's just the normal. First-time home buyer age. And I think it's because prices have obviously gotten a lot higher. People kept renting, and now there's so much demand, and they're all trying to buy at the same time. Like, time doesn't stop. You still have the next generation trying to buy now too.
Yeah.
So you have almost two generations of first-time home buyers trying to buy at the same time in a sense. And I think that's ramping prices up. It's also just crazy that the first-time home buyer price point is like $500,000 to $600,000 now.
Yeah.
Where it's like,
I feel like back in the day, I mean, I've had my license for 8.5 years, but I feel like, when I say back in the day, I mean like maybe 20 years ago, first-time home buyer price was probably $200,000 to $300,000. That back then that could have been a single-family home, condo, townhome. But yeah, now, especially in Bucks County, I mean, it's again, for those of you that don't know, I mean, I'm doing business all over Jersey, all over PA. It's not just Bucks County. Obviously, we're hyper focused in this area. At least I am. But yeah, the prices to live in this county they're competitive. They're high. They're tough. But that's for a good reason. This is one of the best places to live in the entire country.
right.
And I'm bullish on Bucks County until the day I die. So like, and that's mostly where I operate my business, between Yardley, Newtown, New Hope, Doylestown, Warrenton, Percy, Pipersville, like all these areas up and down the river.
Yep.
And it's just tough. So it's like whenever you get somebody pre-approved or going through the process, they're all excited. They're like, oh yeah, we're pre-approved, we're good to go, this is going to be great. And then they jump into the reality of home buying, and it's not always that easy. So what do you see as like the most common like loan type? I mean, is conventional the most common? Are you seeing more FHAs, more VAs? Is it kind of like a nice blend of both? And you can maybe tap into like what those loans are, like what does conventional mean, et cetera?
Sure. So I think, in terms of like what the gold standard of mortgages are, a conventional loan is always looked at as the gold standard. I mean, if you're well qualified, high credit score, have 3% or more down, and you can qualify for a conventional loan, that'll put you in the best spot to get your offer.
And the 3% is the first-time home buyer.
First-time home buyer.
And then
for a repeat buyer, it's 5%.
Gotcha.
And then once you put 20% down, you don't have PMI.
Yep.
Or sometimes we can get rid of PMI with less than that down. But that's always looked at as the gold standard. We have seen overall, I would say, credit scores have come down as a whole in general.
Mm-hmm.
So we are doing more FHA loans in general. I mean, FHA is a great program. It's a government program. So the interest rates are a little bit lower on it.
Yep.
But the trade-off is you have mortgage insurance for the life of the loan, regardless of the down payment. Whereas conventional, you only have it until you hit 20%.
Okay, so even if you're an FHA loan, 3.5% down, whatever it is, and you get yourself to 20% equity in the home, you still have the PMI for an FHA.
Right.
You can't can you transfer for if you refinance? Can you refinance an FHA?
Yeah. So what we do is Movement waives the origination fees on the refi. So we and the customer knows this when they're getting an FHA loan, that at some point, not right away, probably 5, 6, 7 years down the line, if they're just paying their loan like normal, it'll make sense to refi to a conventional loan.
Gotcha.
Now there's a lot of unknowns with what does the market do in the interim. For example, if somebody bought 5 years ago with an FHA loan and their rate's 3%, they have PMI, still might not make sense to refi it. Depending on what that difference is. So we look at everyone on a case by case basis, but on average, everything else being equal, you would eventually refinance to a conventional loan to get rid of the PMI.
Why are the FHA rates lower? I guess that's
a good question.
I don't think I've ever really asked the question, because I've had plenty of FHA buyers. I've always kind of wondered if the buyer is not qualified based on whatever reason, like credit score, whatever it may be, to get the conventional, why is their rate lower?
Mm-hmm. So conventional goes down to a 620 minimum credit score. FHA goes to 580. So you have a little more flexibility with FHA. But the reason the rates are lower on average is because there's two components to FHA mortgage insurance. You have the monthly portion, and then you have the upfront portion.
Mm-hmm.
The upfront portion is 1.75% of the base loan amount.
Okay. And so that's closing costs up front?
That just gets rolled into the loan. So the buyer doesn't pay it out of pocket.
Gotcha.
So if you ever look at a loan estimate with the FHA loan, you'll notice that the base loan amount isn't just the simple math of a conventional loan where if it's 10% down, then the loan amount's 90%. It's always a little bit higher because you have that mortgage insurance built in.
Gotcha.
Now that mortgage insurance is basically to protect the government if anybody defaults.
Okay.
So if somebody defaults on an FHA loan, the government is protected because there's a huge fund holding all those upfront premiums in it.
Yep.
And that also keeps the rates down on them. So like conventional loans, like different credit scores, 700, 720, 740 will be much more susceptible to movements in rates versus FHA. Somebody with a 600 credit score versus somebody with a 650 will be similar because FHA allows more flexibility with that.
Gotcha.
And the trade-off is the mortgage insurance.
Gotcha. Okay.
So it's a foot in the door. I mean, it's a great program.
Yeah.
FHA also kind of goes somewhat hand in hand with VA, which is my favorite loan program.
Yep.
VA loans are the best loan program out there.
Yep.
Like legitimately, they're the lowest rates. It's 0% down for veterans. In some cases, you can have them legitimately buy a house with no money out of pocket. Technically, it's a 4% cap on seller assist, but the way that the VA guidelines are written, there's no cap.
Yep.
So you can technically structure it so they have no money to close. They go up to a much higher debt to income ratio. Both FHA and VA go higher than conventional, but VA specifically goes really high. There's actually technically no cap.
So it's and I know correct me, hopefully I know this by now. So for a conventional loan, what is it like? You don't want to be any worse than 50-50 debt to income, or 60-40? I mean, what's the...
good question.
On that? Yeah.
So really the guideline is 45% debt to income for conventional, but we can usually get it to score up to 50 if all the other factors are strong. So 50 you look at as the max debt to income of your gross income versus your monthly debt.
Yep.
Monthly debt being specifically what's on your credit report and the new mortgage.
Okay.
So like not grocery bills or anything like that. Anything tied to your credit is what we look at. But FHA will go up to 56.9%.
So 56.9 debt
to income ratio
is gotcha.
So it's crazy if you think about it. Like you can be spending more of your money on debt than you're saving and still qualify. Now VA, I've had VA loans get approved at 65% debt to income ratio because there's other calculations they do with residual income. And honestly, on average, it's all based off how these loans perform on the secondary market in terms of default. Like VA loans, they might be 0% down, so people might think, oh, the buyer has less skin in the game.
Yeah.
But the reality is those buyers pay their mortgage on average, like the default rates are low. Yeah. So it makes sense. You know what I mean? Whereas FHA might have a little bit higher of default rate given the type of program it is, but overall still that's how they kind of figure out what the rates and the mortgage insurance should be on these loans is how many people are actually defaulting on them.
Yep. Since we're on like loan types, we're, as you can probably tell, I used to have I wanted to have like a notepad on these podcasts and like structure. Like, what am I going to ask Mark? Like minute 1 is this, minute 5 is this, and we were actually talking about it outside with the guys. It's like, do we just wing this thing or do we structure? And it's funny. It's like now somehow we got onto the loan type, even though I wanted to try and get onto that like 20 minutes in, but here we are. So I mean,
just rolling.
Hey, that's what we do in the Wolf Den. So now that we're on loan types, I think, and not everybody, but I think the average buyer out there in the market has heard of conventional. They've heard of FHA. They've heard of VA. Maybe touch on 2 or 3 other types, whether it's new construction or.
Yep. So we're doing a decent amount of jumbo.
Yeah, just like jumbo loans, like 2 or 3 other types of loans that maybe the average buyer in the market is just simply not aware of.
Okay. So I would say the 2 that come to mind are, first off, is jumbo loans, because a jumbo loan in our area is anything over $832,750.
And is that the loan amount, or is that the
loan amount?
That's the loan amount. Okay.
So, you can borrow up to that and be a conventional loan. Now, from a borrower's point of view, there's not a whole lot different from a jumbo loan to a conventional. It operates the same. They're usually 30-year fixed. You can do adjustable rates as well. But there are underwriting guidelines on the jumbo loans that tend to be more strict, whether it's with the appraisal. Like a lot of times on conventional loans, we'll get appraisal waivers.
Yeah.
Jumbo loans always require an appraisal.
Like the bank has more skin in the game. Is
Right.
that the reason
So
for
this
it?
is this is the reason why there's a difference at all, because Fannie Mae will back conventional loans. All conventional loans are called conforming loans. That's the $832,750 amount. They're backed by Fannie Mae and Freddie Mac, which means they're quasi-government organizations that will essentially protect from major default.
Yep.
You know what I mean? So they're not, conventional mortgages aren't private. Whereas jumbo is always serviced by either a large bank, Movement services some jumbo, but they're always underwritten based off of that investor's guidelines. They might have different appetites for certain things because they're keeping the loans on their books. They can make the rules. They don't have to abide by Fannie Mae. So there's a lot of nuances there. We probably have 30 different jumbo programs that we look at.
Okay.
We have a couple that we especially use. The rates are slightly lower on them, and there's a lot more you can do in terms of like getting creative with the down payment. Like if somebody doesn't have the 20%, for example, but they're selling their house, we a lot of times we'll use a HELOC on their departing residence, or we do a lot of recasting right now too, which is a whole separate topic. But essentially, recasting allows you to get your payment down to what you would have gotten if you put that amount down initially. So a lot of people think like, oh, I'm stuck with whatever I put down at closing. But let's say you sell your other house after you buy the new one.
You just recast the mortgage.
You could put it towards the mortgage. If you just put it towards the mortgage and did nothing, your payment wouldn't change. You're just cutting your loan term down. But if you put it towards the mortgage and recast, now it's re-amortized over the remaining 29 and a half years or whatever it is. And then so it brings your payment down to what it would be initially, which is a nice tool that we use a lot. The key with recasting is it's not always available because it depends who's servicing the loan. So like Movement as a whole, we service a lot of our loans, so I can say, yes, this can be recast.
I can still tell you that I've had Movement for 2.5 years, and they're still my lender. You guys haven't sold my mortgage as far as I know.
No.
Like I still have my portal. Your face is still on it.
That's great. That's
great. 2.5 years later, Movement is still servicing my mortgage, and I couldn't be happier.
I told him not to sell it. No, I'm kidding.
How about that plug? Actually, I was gonna actually. So the client that I'm not going to mention names on air, but I mean the client that I was talking to you about outside, they were asking about recasting because the house that they're looking to potentially make an offer on is it's listed at 1.2 million, and it's kind of like a multi-generational sort of purchase where like grandma, mom, the husband and wife, the kids, they all want to live in on the same property. So they don't think you'll be the one that tells them if they have to be contingent or not, but they're pretty sure they don't have to be contingent on selling their other 2 homes to get the mortgage. But then they're asking, hey, once we sell the other 2, let's say they sell the 2 homes for a total of 1.5 million, can they put $500,000 and like recast the mortgage on the new house? And was it like a $500 fee, or is it like a one-time fee of some sort?
We usually get waived for our customers. I think it's $500.
Movement might waive your recast fee.
Give me a call.
They might waive your appraisal if you know me. So a little friendly play. Not a guarantee. I don't want to get Mark in trouble.
But the key is...
We can cut that if you want.
People are working with different lenders. No, it's all good. But like the most important part is like, for instance, let's say somebody's working with a broker, not knocking it, but they don't know where that loan's going.
Gotcha.
So they can't say it can be recasted or not, especially if it's a jumbo. Conventional on average usually can be recasted, but jumbos all have different rules. Because let's say you get a jumbo loan for $1 million, then the next month you pay it down to 700,000. Now it's not even a jumbo loan.
So if it gets sold, so if it sticks with you guys, that's fine. But you're saying if like, I'll just use your company as, so if Movement sells it to Provident,
Right.
or whatever, or whoever, then Provident may not have, like, they're not looking at it as a jumbo, like they're buying it under the 800 and whatever,
Right.
under the jumbo threshold. So now it's just a conventional loan.
Correct.
Is
It
that what you're
changed.
saying?
Yeah. So it's basically,
Okay, yeah.
so I don't want to speak for like a company like Provident, but
Yeah,
like
yeah.
sometimes it's not allowed because it wasn't how it was underwritten. It doesn't fit into their guidelines. But
Gotcha.
usually for jumbo loans, we would know where it's going.
Okay.
Because we price, when we price a loan, we're looking at a whole list of different loans, and they're called like Truist, or we have relationships with Goldman Sachs or JP Morgan, all these different companies that we essentially write loans for. They give us, they allow us to basically operate as an arm of theirs, and there's no real difference in rate like if you went to Movement versus them, but essentially it just allows us to offer these programs.
Yeah.
And the reason that a bank like JP Morgan would want to partner with a company like Movement is we're only doing mortgages.
Yeah.
You know what I mean? We're not a bank where people are walking in, getting checking accounts or opening savings accounts. Like, we're just talking to a lot more home buyers on a daily basis. So it makes sense for them to offer it. So jumbos is a big one. And then I wasn't going to talk about this, but it just popped in my head. I think it's something people don't realize is we do a lot of family opportunity mortgages.
Okay.
Which is...
See, I've never heard of that. So I'm learning with all you guys here.
Yeah. So if you remember,
yeah,
we had a client, I won't name names either, but like it was a good fit for him. And you probably didn't realize it at the time, but if you have older parents, or you're in a situation where you're the caretaker for somebody, you can buy a home for them, or co-sign on a home for them as a primary home, even if it's not your primary.
Okay.
So, and they don't even have to co-sign. So like, let's say, I'm just making a scenario up, somebody's parent, wanted to downsize, their house was too big, maybe they were on their own, and they were retired. They didn't have, maybe they had Social Security, but no pension or anything like that. They couldn't qualify for a mortgage.
Yep.
So people might think, oh, well, if I buy a home for somebody else, I got to buy it as an investment property and rent it out to them.
Yep.
But if it's a parent or if it's a family member, it's called a family opportunity mortgage.
Okay.
You're essentially buying another primary home. The rates are low. Like, the primary homes are the lowest rates.
Yep.
So that's why people want to do it, and the lowest down payment. So essentially it allows you to buy a primary home for somebody else.
Okay.
So
Wow.
something that people don't realize, obviously you can't take advantage of it,
No,
but
no.
it's situations where...
I'm assuming obviously everything gets sourced and everything. Like, you have to obviously verify, like, this is my mom, this is my dad. Like, obviously, when we go through the whole title process, clearly if anyone's trying to scam something, it gets snuffed out pretty easily. So,
or if somebody had a history of doing a new family opportunity mortgage once a year, then it probably would get caught.
Yeah,
but
you don't want to take advantage of a good thing. I mean,
don't commit mortgage fraud.
Yeah, people that are out there doing that are just we'll just leave it at that, because I'm going to say some pretty nasty stuff that people that are taking advantage of programs. But
it's not worth it to save a 0.25%.
No.
But anyway, it's a little known thing, and it's great because it just opens up your options. Like, when you think you have to buy it as an investment, it's 15% down minimum. The average rate on investment property is usually 1% higher than
I
primary.
thought investments were, they were 25% down minimum, or is it?
So they changed.
Because this might be news to Krista and news. I'm thinking of buying an investment property. So
Nice.
actually, I think I did tell her. So all right, so I think I'm safe there. But
so it's 15% for
okay.
single family, and then it's above that it's 20% down. So
so when you say single family, are you talking like a townhome?
Yeah,
like, you're not talking like detached versus
house.
like.
No, it doesn't matter.
Okay,
detached.
so
it just means one unit.
Yep.
So it could be a condo, it could be a townhouse, but it's one unit. It's not duplex.
Okay.
So those are 15% down minimum. If you can get to 20 to 25, the rates are a lot better. But 15.
But generally, if the rates are 6 now, they'd be like 7% for an investment property.
No, well, we just got this program now that's smoking everyone on rates.
Okay.
It's basically like a 0.5% higher than primary.
Okay, because I'm actually dead. I might be doing that this year.
Yeah.
So we'll be in touch.
And then we could look at doing it.
Yeah.
Sometimes we could do it as second home. Second home is 10% down minimum.
Gotcha.
The reason that we would do certain cases as second home versus investment. Now, we don't want to get too into the underwriting guidelines here. If you're going to just rent it out, it's an investment property. But for instance, I bought a property in Florida a couple years ago that we used a couple times. I bought it as second home, but it's fully rented out now.
Gotcha.
Reason I want to do it as second home is because you could do 10% down instead of 15.
Yeah.
And the seller assist caps are different. So on a second home, you go up to a 6% seller assist.
And what about investment properties up to 3? Is it 3%?
2.
Oh, it's 2%. Wow.
For Fannie Mae.
Okay.
Then there's like DSCR loans and stuff that allow up to 6. But so it gives you more flexibility there. For instance, if a house is sitting and you're doing it as a second home, you could use that assist to buy the rate down.
Yeah.
It could be a huge win.
And I'm assuming there's PMI.
Yeah, there's
right?
PMI.
Anything under 20%, no matter what the loan type, there's PMI.
There is, yeah. But I mean, you could there's ways we get creative with like single premiums and stuff like that, especially if you were doing 15% down. So you're not paying monthly PMI. But the main difference between why someone would do it as second home and investment is when you're qualifying for an investment property, we could use 75% of the projected rent to help you qualify.
Okay.
So it kind of offsets that mortgage, whereas second home, we can't use any rent.
Gotcha.
But the trade-off is it's a lower down payment and usually slightly lower rates than investment.
So if I buy, again, like hypothetically, and again, this is, kind of tying into the whole like loan type thing, like an investment property as getting a loan for an investment property. So if let's say I were to buy I buy a $500,000 townhome in Newtown and I project the rent to be $3,500 a month.
Mm-hmm.
So if you instead of like putting that, and let's say my mortgage is also $3,500 a month. Okay,
right.
So instead of hitting me with that $3,500 a month on the mortgage end for my debt to income and all that kind of stuff, if the projected rent is $3,500, you can take 3/4 of that, and so that way instead of $3,500 hitting my debt to income, it's really only
25% of that.
Yeah, 2,800 or whatever the number is.
Right, exactly.
Okay, that's cool.
Yeah, so I mean, in terms of, it really comes down to qualifying which option you would go.
Yeah.
Some people need the rental income to qualify. Now, I'll just say people can get themselves in trouble if they're buying a lot of rentals and not showing rental income.
Gotcha.
So what we do on our end on the mortgage end has nothing to do with what people report to the IRS. If you're, like for instance, that property I mentioned in Florida, I rent it out, so I show rental income on my Schedule E because when I go to qualify for another mortgage, I want that debt to income staying within reason. You know what I mean? So everything's a trade-off. I mean, I'm not going to give tax advice, but I just see people get into problems when they otherwise would be very well qualified, but they didn't show the rental income. So now, once you own the property for a year, we can't use the lease. We have to use the returns. What's shown on the returns. So if it's a rental and you're not showing that income, now it's just counting those properties against your debt to income.
Yep.
So eventually you're going to cap out.
Gotcha.
So, we always take a look at that. We offer guidance when we see certain things. We'll never tell somebody how to file their returns, but like I always tell people, listen, if you want to invest in real estate and you're starting to try to, really get going, like you just got to do it right. Claim the income. Maybe if you're later in life, you don't need your debt to income ratio or your credit score, then do what you got to do. But if you're trying to build something and you're young and you're worried about keeping that debt to income ratio in line, it's really important to show that rental income.
Absolutely. I mean, unless there's like another, I think we just went through like 2 or 3 more different loan types. I mean, unless there's another one that you want to harp on.
That's pretty good. Yeah, that's pretty good.
I mean, listen, there's a million programs out there that we can always talk about. I mean, actually, one thing, speaking of loan types, I mean, what can and can't you guys do, or more so, what can you do with like new construction?
Mm-hmm.
I mean, because I know a lot of times I have a buyer that wants to go buy, new construction Toll Brothers or new construction whoever, and they're to use the lender in house at the new construction, like at this whatever lender's tied to that builder. They have all these sort of deals in place where if you go through me, you get this. What we'll pay for your closing costs, all these things, and it's like I've always found it tough to get a buyer, over to you or over to whoever for a loan when the builder has a lender that's doing new construction loans and their rates are low, their closing costs are paid for, and it's like, are you guys able to compete with that? I mean, is it?
So, I mean, here's what I'll say. I think certain times, like if I see a loan estimate and it's just, we can't even come close, you got to tell them this is the best deal you're going to get.
Yeah, good luck.
But sometimes, like some builders, it's a no-brainer. Other times, I've noticed that they'll kind of put the incentive is a little bit smoke and mirrors because let's say they're offering a $10,000 incentive, but they're using it to buy your rate down to only 0.25% below what rates are.
Yeah.
Then I always tell the buyer to get an estimate with no points. What rate are they really offering you? And I just did this with a buyer in Delaware end of last year. He was buying Toll Brothers, or no, I think it was it Lennar? I think it was Lennar.
Okay.
So he was like, hey, I've done 2 loans for him in the past. He's a great guy. He's like, hey, here's what they're offering. I was like, all right, that looks pretty good, but ask them, instead of them using the incentive to buy points to lower the rate, because there's a lot more, they can get weaselly with that.
Yeah.
Tell them you want an estimate with just the credit, no points. And the rate was 7.5% at that point, but he was saving 10 grand. And I was like, listen, here's the smartest way to do this. Take the 10K, close, and we'll refinance you right after.
Yep.
So I think it was actually like 15K. I can't remember the exact numbers, but he closed without buying the rate down. He just took the incentive. So basically paid for all his closing costs.
Yep.
A month after he closed, we refinanced him down to 5.99.
Yep.
So he dropped his rate up 1.5 without paying for any of the points to do it.
Yep.
I didn't charge him any points because rates happened to drop in the interim, but he's singing our praises. So he basically got his cake and ate it too. He kept the incentive without artificially using it to lower the rates. So I think that's kind of like the goal. Sometimes it is a good move, sometimes it's not. But I just think when they're just giving you the incentive and throwing a lower rate, sometimes people don't realize that they're overpaying for that rate.
Yeah.
You know what I mean? So I think that's the one thing to look at.
Yeah, and whenever I'm talking to buyers, like even if a lot of the conversation is, hey, I got my buddy Mark, do you want me to refer you guys over to him? And a lot of the things, we were talking about this the other day, a lot of times the buyer is like, oh, well, I bank with Chase, all my money's with Chase, or all my money's with, Bank of America, whoever. And they're offering me a low rate, yada, yada, yada. So what I always try to harp on is, well, number one, you can use whatever lender you want. I think Mark should be your guy. He's who I recommend, but it's the buyer's choice, not my choice, not your choice.
Sure.
So I always say, guys, listen, if you're getting like let's say the rates are 6% and you're getting a 5% rate from Chase as an example, like if it's no points and they're giving you a low rate because you opened up a new checking account and they're giving you an incentive, which does happen, then, Mark will be the first one to say, best of luck.
Go ahead, man.
We'll get him next time, But look at that closing cost sheet. And there's a lot of companies out there that are, again, like smoke and mirrors, where it's like they give you a good rate and it's not the buyer's fault. The average buyer doesn't know any better. They don't look at the closing cost sheet. They don't see the $13,000 in points they're being charged to get that rate down.
Right.
So that's why I always say, listen, I'll work just as hard for you if you use Chase over Mark. It doesn't affect me, but send me the closing cost sheet. Let me send it to Mark and let him put eyes on it.
Yeah.
If you're getting a better deal and they can't match it, best of luck. But more times than not, there's something in there that they didn't fully explain to you. And they're going to explain to you when it's already too late. You're 2 weeks from closing, and then, oh, by the way, here are the preliminary numbers on the Alta, and and the buyer's like, what the hell?
Right.
Like, what is?
It happens all the time.
Yeah, and it's like, it's tough, and it's not. There's nothing illegal about it. It's just like, maybe it's unethical, but like you want to.
You got to know what you're signing. You know what I mean? Like you got to know all the numbers. Like if the rate is well below the market. Why?
There's usually like you can't just like, listen, if I could have Mark make up a rate for you guys,
I'd give everybody 0%.
I would, 0%. Yeah. I mean, like free money. So, but it's,
you just got to know what you're signing. And like I said, like I always say, like, listen, send it to me. Usually we can match it, so it's not a problem. But like, I can tell right away if they're doing something, and if they're not, and it's a good deal, I say, listen, Mr. and Mrs. Buyer, I would take this myself. Go ahead, do it. And that has served me well because. One, it's just good business. You're being an honest person. And two, a lot of those people that end up using some bank or whatever, they don't have a great experience, and they refer everybody.
Oh, yeah.
Because they feel bad that we did the work and they didn't stick with us. And two, I was honest and respectful and told them my opinion of what to do.
Yeah.
You know what I mean?
And I know we harped on this way back on episode 2 in probably September. It's not just about the rate. It's not just about the closing costs. It's the service. And I keep harping on it where it's like, if you're using a bank or if you're using a lender who's based in like Washington State or somewhere else, it's like once 3 p.m. on a Friday hits, as a realtor, I can't reach that lender until Monday of next week. Like if I need it, like I can run my own closing costs and I can usually get within a margin of error through the MLS. But if I have a question for the lender, if the mortgage commitment is due on Monday and we still don't have it and today's Friday, like if the number I have is 1888 for that and I don't have an email, it's like I can't even reach them.
Right.
So it could hurt offers I'm writing. A lot of listing agents, well, most good listing agents will call the lender. So let's say I submit an offer on a Saturday and that lender is like, well, that agent is like, I want to call your lender to verify your buyer. What if it's a 188, it's a 1-800 number in California and the office is closed.
Right.
My buyer just got screwed.
Right.
I mean, listen, they still might get the home, but like that the service goes such a long way.
Right.
I'll harp on that every time you're on this podcast, where it's
Right.
like that is so huge. There's been times where I've reached out to you and you'd like walk out of a bar and talk to me.
Oh, all the time.
Which we have socialized, like walk out of the bar, you answer my question, or like this guy's on his freaking honeymoon in Aruba. And he's still helping me out with stuff. He's on the beach.
I like working.
He's on the beach with his laptop writing pre-approvals for me, and it's like that is so like that is so big because this business is very time sensitive.
Yeah,
and it's so
it's
competitive.
not just cost. Yeah, I mean, and our costs are low, but it's not just cost. I mean, if you just think about it, if cost is the only thing that mattered, then everyone would get their coffee from McDonald's.
Yeah,
you know what I mean. So like, it's just not. There's more to it. It's people want certainty.
Yeah.
When I'm sending a pre-approval out, it's for certain a pre-approval.
Yeah.
It's not a hope that it's a pre-approval.
Yeah.
You know, they want communication. Hey, Mr. and Mrs. Listing Agent, this is when the appraisal is. Here's the commitment. Here's what we need. If you guys want to move up closing, whatever it is. And usually it starts before the offer's even accepted, as you know. So like there's a lot to it. I mean, and there's a lot of great lenders out there, but I think the ones that I see that have done super well, you know, they lean in on service.
Yep.
They provide great prices and great rates. Obviously, you're not going to get far without that, but that's not going to get you where you need to be.
Yeah.
You need to be good service. It's 24/7 job.
Yep.
It's all weekend. You know, we always say between 8 a.m. and 8 p.m., no matter the day, Sunday to Sunday, if you need a cost sheet or you need a pre-approval, you're getting one.
Yeah.
You know, after that, I'll try my best to get it.
Yeah.
It might be in the morning, but we have to sleep too.
I have 8.5 years of being able to attest to everything he just said. I mean, it's just you end up using Mark, you're in great hands.
So he considers himself the wolf of Bucks County. So I want to test his knowledge. So I read an article about the top 10 zip codes people are moving to in Bucks County. Bucks County as a whole is exploding. I want to see how many you can get.
All right, so. And I'm assuming I can do this in like
you can just guess
in like no particular order.
Yeah, I mean bonus points if you can get.
All right, well I'm just gonna go in no particular order. Okay. All right, so 18938.
18938. Well, tell me that's not on the list.
It's not on the list. Wait, what list did you look at?
No, it's top 10 zip codes people are moving to in Bucks County.
And 189, the zip code we're sitting in is not on there.
No,
that's a travesty.
I don't know who wrote the list.
All right, well, we're off to a great start here.
0 for 1.
All right, I'm 0 for 1. 18902.
Yep, that's on the list.
18901.
That's second on the list, Doylestown.
All right, so those are both Doylestown / Pipersville / Plumstead.
Mm-hmm. Yeah, guess like towns. It's like, you know.
All right, so we just did Doylestown. You know, the 18902 and 18901 are Doylestown zip codes that include Pipersville, Plumstead Township, like a couple different areas. All right, so I'm gonna say Newtown 18940.
That's one. Yeah.
That's my hood.
Can't get that one wrong.
19067 Yardley.
Yardley is 10th.
All right, so let's go.
You want me to
18925.
Not on the list.
Good old Furlong is not on the list.
Furlong's not on the list.
Wow. 18929 Jamison.
It's not on the list.
This is absolutely horrendous. By the way, I'm going to scrub Mark's phone to see what kind of articles he's reading there. All right, so, and actually, all the zip codes I'm naming are amazing places to live.
They are.
So if you need help, forget this list.
This is based off of people of like active searches and
all
people
right,
moving there.
So let's go 18966.
What's that?
Holland, Southampton,
Southampton's
Churchville.
4th on the list. Yep.
That's where I'm from. I grew up in Holland. All right, so that's good. Ooh, 18954 Richboro.
Richboro, not on the list.
This is bonkers.
But next to it, what's next to Richboro?
I mean, Ivyland's next to it.
Bensalem.
19020?
Yeah.
Yeah. Okay, so all right, 19020 Bensalem. 19007 Bristol.
Bristol's not on there.
Let's go. I'm just really showing you that I know all these zip codes. That's the most important part about this. All right, 18974. I believe that's Ivyland, maybe.
Ivyland's not there. Warrington is.
All right, so 18976.
Yeah, Warrington's 9.
All right, so Warrington's on there. Oh God, 18923 Bedminster Township, I think, Fountainville.
No, but what's near that? What's that also known as? Where did we have that closing recently?
Oh God,
starts with a P.
I mean, you have Pipersville, Plumstead, and those. Wait,
Percy.
Percy. All right, so that's 18944. 18944. All right, so Percy 18944.
So that's 7th.
Which
Percy's awesome.
How many are we missing here?
So you got you didn't get 3 yet. Langhorne.
Oh man, that's my first showing today.
I know.
I'm literally going from here
I
to
think
Langhorne.
that was actually all of them.
All right,
Oh, eighth, ninth, eighth was Quakertown. Did we get that?
No, but I do go to Quakertown, but that's not. I don't even think I know that zip code.
I mean, you could name 30 zip codes.
So
here.
Langhorne is 19047. It's like Langhorne, Huonville, Pendle, like those areas, Middletown Township. I guess the whole point of that is like these lists are generated. A lot of them are generated off of like average sale prices or most affordable housing, most popular school districts, most popular shopping areas. Like you never know where these lists are coming from. I mean, I guess the moral of that is that like all those zip codes that I was naming that were just not on this list, which is I still don't understand that. That's for another podcast to find out why that is. But there are so many great areas to live in Bucks County. You know, whether this is going out to people in New York, you know, Manhattan, people in North Jersey, Bergen County, wherever, even like the DC, Virginia area that are moving here. Like Bucks County has, you know, forget 10 zip codes. They have 20 great zip codes.
Yeah.
Almost the entire county is amazing to
New
live in.
Hope. I mean, like all.
Yeah, like we're sitting here in New Hope right now. Like this is such a fantastic place to live. And you know, Montgomery, even like Montgomery County, like down in like Chester and Delaware, where you are, like all these areas are so great. You know,
there's a reason the Northeast is the appreciation is way higher than the rest of the country.
And that's why I'm not afraid to maybe buy an investment property, because I know that, let's say after like a year or two, I decide that I don't like being a landlord. I don't want to deal with the tenant. It's just not my thing. As a real estate agent, I want consumers to know there's no better place in the world to put your money than real estate, whether it's residential, commercial, whatever. So I know that after like a year or two, if I want to sell the place and I don't want to be a landlord, then I know for a fact I'm going to get my money back and probably then some, because I parked my money in a great spot. So that's huge. All right, so this or that, 30-year fixed or 15-year?
I would say 30-year fixed, because you could always prepay a 30-year fixed down into a 15-year, but you're not stuck with the payment then.
Okay.
And it also leaves your debt to income lower for if you need to use it for anything else, car, house.
Best interest rate at the moment, FHA, VA?
VA always.
Okay.
No matter the time of year.
Yep.
No matter the market.
All right.
VA is probably in the, I would guess, like 5.25, 5.5 range right now.
All right. Cheers to the veterans. We love you guys.
Thank you for your service. Beach or mountains?
Beach or mountains.
I'm helping him out.
How about a lake beach in the Poconos? Just a beach on the lake in the Poconos, and there you go.
That would just be a lake.
Yeah. This is going down a rabbit hole now. Doing pre-approvals on your honeymoon in Aruba or doing pre-approvals at a bachelor party in Vegas?
Honeymoon. My wife.
Earmuffs, Dana.
My wife will let me slip, but my boys might not.
You know, his wife Dana's in the business, so I think she understands.
She's great. I love her. We got married in September, and it's been great. So, thank you, Dana. I got one for you.
All right, go.
New construction or resale?
I go resale. Just because, and I've done plenty of new construction deals. Yeah, I've done new construction. He bought new construction.
Oh, yeah.
So, yeah, listen, new construction is great. The problem I have with new construction for me is I don't feel as involved. Like I kind of lose control. Not like control, because I trust Toll Brothers. I trust, you know, Fox Lane. I trust DeLuca. Like I trust them all. But I kind of get pushed to the side.
Right.
Like I tee the buyer up. I'm involved in the sale. I get a piece of the commission. Like it's great. Like it's totally fine. But I'm not like step by step. Like the builder kind of takes over, and I'm just kind of like, hey guys, I'm just checking in. Is the frame up yet? Has the roof gone up? Like I'm just kind of like, just trying to be involved and like almost like trying to like show my client that like, hey, like I know that you know I'm getting paid on this. I want you to know that I'm still here.
Right.
And I kind of feel bad sometimes, but resale, I'm there lock and step every step of the way. Like I am there. Like from a selling standpoint, I'm there from the first meet, the listing contract, the open houses, the showings, the negotiating of offers,
inspections,
everything. Everything. And
inspections are big because you don't have them on new construction.
Yeah. And the only inspection you're going to have on new construction is really just
CO.
Yeah, just the CO, and you're going to have, you know, the builder does their own like final walkthrough, and they'll blue tape certain things that need to be touched up, you know, stuff like that. But, you know, and I resell for a buyer, I'm there from the first meeting, introducing them to a lender. You know, like inspections, the whole thing, showings. Like
Sure.
I'm there, and I feel very involved, and I feel a lot more. It's a lot more gratifying when I'm at the table. Not that it's not gratifying to see somebody buy new construction.
Mhm.
It's so much more gratifying when I'm at that table, knowing that like we just sweat through God knows what hurdles to get here. It was sometimes it's a battle, and I'm sitting there watching them get the keys
Yeah.
in their hand, and it's great. So that's a very long answer to this or that. I mean, I choose resale.
Yeah. Seems
for
like more
sure.
fulfilling from my point of view for you, because like I feel like it's more competitive to get a resale offer accepted. New construction, usually there's a little more leeway.
There's no bidding wars.
There's not as many bidding
sometimes
wars.
they might, if anything, they'll lower the price if the models are sitting there.
Right.
But I mean, there's no.
Normally there's multiple houses to pick
Yeah,
from.
you put down a deposit, you reserve the lot,
Right.
and there you are.
Resale is this
it's-
one house. It's unique. It's one of one. There's
Yeah.
10 offers. How do you structure the offer to get yours accepted?
Yeah.
It seems more fulfilling.
And again, like, and a positive for new construction though is like, again, like, yes, it's easier for people like me where I don't have to be as involved. So yes, that gives me more time to go out and help the other people I'm working with.
Sure.
So yeah, I mean, there's positives and negatives to both.
Sure. And obviously the
But-
builder matters too.
Oh yeah, the builder
Yeah.
matters. I have a recent partnership with Prime Builders. They're a big builder up in this area. So anytime I'm going to list land, I'll do a building package with Prime, and we work out the commissions ahead of time. We work out the base price of the model and all that kind of stuff. So yeah, new construction is great. I'm good friends with Nick DeLuca, so
Nick's great.
I'm integrated with these builders, but
Mhm.
I'm going to promote myself as resale. Like
Yeah.
I list resale homes. I help people buy resale homes, and then on the side, I do new construction.
Sure. Makes sense.
So that's pretty much it on my end. I mean, listen, I think at the end of the day, this, at least my business, as far as what I have closed right now and what I have under contract, and you mentioned it earlier, the same thing for you as far as your volume. Between this time last year and this time this year, it's going to be a crazy year. If you're a buyer looking to jump into the market, if you're somebody who's looking to sell their home, April, May, and June are the hottest 3 months to sell your home, to have inventory on the market as a buyer. Yes, it's going to get competitive. The rates are hopefully going to come down a little bit more, and it's just going to fire things up. So I think we're heading into an extremely busy real estate season. I think busier than last year. Don't let these scare tactic articles fool you. Don't let these, you can go down a rabbit hole on Instagram and Facebook and LinkedIn and see all these, like, all the talking heads about like the market might crash, whatever's going on overseas. Like,
Yep.
listen, none of us know what's going to happen. All I can tell you is from what I see and what you see
Yep.
is the real estate market is exploding.
Right.
It's going to continue to explode. It's a great time to jump in, and we're here for you.
Here's a good
So-
taste of what we're seeing in the market. I had a client last week lose an offer. There were 20 offers on the listing. So whatever headlines you see about the national average, this is dropping, just remember that real estate, you can't just Google real estate. It's hyper local. That's why people like Jason, who are boots on the ground, and lenders that are local, that's why it's so important. It's
Yeah.
because it's not easily replaceable with a quick chat GPT. Hey, am I overpaying for this or not? You got to talk to professionals that are doing it every day to really know that. So,
Absolutely. All right, well, you're the man.
thank you, brother.
I appreciate
Welcome.
it.
Appreciate you
Oh,
bringing me back to the
absolutely.
den.
Cheers to all my Wolf Den followers and soon to
Here,
be
let's
followers,
do
hopefully.
another.
Dude,
We got to do another one there.
Dude, absolutely. Now, listen, that's it, guys. We'll wrap up episode 6 here. Your good old lending update for the spring market 2026. We're happy to have you. I'll see you next time. Thanks so much.
See you guys. Thank you
Cheers.
for having me, Jason.
My pleasure.